All right. So welcome to EPS Momentum webinar. We have today we are going to talk about the post-earning announcement drift, something that is really famous. I mean, it's not really that well known by investors, so I won't say it's famous, but it's very powerful. And we're probably one of the only platform that presents it in a very comprehensive format and an exciting one. So when you arrive on the main application, which is this, you have a series of macro numbers and monitors and so on. And one of them is the stock drift here, which is a model that goes over a couple of stocks that are in special configuration with a positive drift. So I can pick a number of stocks, let's say liquid US, and I can see stocks that have the distance to the end of their drift of about 8% or 6%. And that would tell me that they have room to grow for the remainder of the quarter. So let me explain exactly what it is. So post-earning announcement drift, you'll have the full explanation in the knowledge lab. You have a full video about it, post-earning announcement drift here. So it's very, very important for you to have a look at it. But what is it? So what you do is first you pull up the widget, which is this one, drift forecast. And then it shows up on the side, and then you can pick any stock and see how the drift is being displayed on the side. REGN, and that's it. So it displays a series of cone and price projection for prices. So let's do a deep dive into what it is. I have created some dashboard that would paint a chart, a monitor, and just a drift. So the drift widget. So the drift widget here, we will enlarge that widget. We'll start with 40 quarters, and I'll explain in a second. So what is it? I'll start with the stock, and what it does is it paints the 4 different scenarios of your reaction to an event. So when I say your reaction is human reaction to an event. Humans usually react to an event positively or negatively, or overreact or underreact. So there's 4 cases where you positive, underreact, positive, overreact, negative over, and negative under. And this is defined by the first 24 hours of trading after earnings. So market reacts to trading overnight. So there's an initial move, which is positive or negative. And then the next day, that second session of trading, which is actually the first full session of trading. It's not the post-session or pre-session. The full day of trading after earnings, you have the majority of the investor that would follow the stock or leave the stock or sell or buy, but basically their sentiment will transpire in that first day of trading. So when you have 2 real positive in both the overnight and the daily session, you have something very unique, which is a positive underreaction. So again, we are looking at the day of earning and the overnight reaction, right? So here we have a positive reaction and then a negative reaction during the day. So it's drift B. So we've identified drift A, B, C, D, A being double positive, B being positive, negative, and then negative, positive, and double negative, right? So D is supposed to be the least important. So the nice thing is for every of these drifts, we have 3 numbers. One is the accuracy. You see 70.59%. So that means that the stock, when it's in drift A configuration, is going to fall in that range of price 70% of the time, 70.5% of the time. And this is based on 17 out of 40 samples. So we take 40 quarters. So imagine we take all the quarters back in history here, about 10 years of history, all quarter 1, 2, 3, 4, 5, all the way 40. And we aggregate and average the mean of the quarter, the max and the minimum of each of those quarters. And then we bucket them into drift A, B, C, or D. So again, if the quarter has started with a positive overnight and day session, then it's a drift A. If it's double negative, then it's a drift D, right? So we bucket them, and you can see that 9 sample over 40 here, 17 here, 9 here, and 11 and 40 here. So, yeah, this is the base. The second thing is you see average move 10.63%. So the drift D being negative as it is still represent an average of 10% increase from the day of earning all the way to the end of the drift. This one represent a 0.31, so kind of flat. This one 5.82%, and this one 36%. So when people positive on NVIDIA, they positive big. That means NVIDIA is tilted to the upside in a significant way, right? And we can pull up other names, like let's pull up Amazon and see what we have. So Amazon here, we have drift A, B, C, and D. Drift A is up 18%, and you have 25% accuracy, so it's pretty inaccurate. The average move here is 10%. Accuracy is 75%, so kind of decent. And drift C is negative performance, minus 2.7, and the accuracy is 90%. And drift D is minus 0.23, and accuracy 68. So today, what we have is a drift D. See, it's surrounded in yellow here. There's a yellow quadrant. And drift D is painted here. So what you see is the stock price at 228, which is here since the beginning of the quarter. It's a drift D, and you see that big drop here. This is what I'm talking about. Big drop overnight and big drop during the day. So 2 drops and a significant drift D. So it started the quarter in a pretty bad way, and now hopefully it'll recover. So in theory, all those drift D here are heading to 233, which is kind of flat for the quarter. And you see how Amazon has been down and then retracing and following its mean kind of religiously here, really following the mean. What you can do is you can insert standard deviations as well to have a more refined cone. So I can see that, the 66% of occurrences that will fall on that 265 and 201 region, right? So imagine owning that stock, you want to short a call against it. Well, the 265 mark is probably the place to start with, where you'll say, well, it's unlikely you'll go there, and very unlikely they'll go over 287. So this is very important and very key to narrow down your range, inserting those standard deviation. Second thing I can do is I can flick it to 20 quarters. So instead of 40, I get 20 quarters. So obviously the cone is going to be more, I'll say contained or more tight or tighter. The move is like minus 5% now. So it's a little bit less performance, but it doesn't mean that it's something significant. It's just a matter of the last 20 quarters. And then you can also have the 2 standard deviation move, and you see the difference. Okay. Now we go back to 40 quarters, and I'm going to show you something interesting. On top of all this, we have the ability to see the drift in history. So I can see all the drift here in history, and I can see the average accuracy over all of these drifts, right? So this is the accuracy that is progressing, digressing, or progressing, depending on how many drifts we put in, right? So you see how it is pinning in, out. So the previous drift was in, right there. The one before was out by not much though, by $9, but it was out. The one before was right in at the end, or the max. The one before was kind of in the middle. One before was in. One before was in, and so on. 2023 was in just at the max the minimum, sorry. Here hitting the max almost. Here hitting the mean almost, right? This one was out. Let's see how, see, this is important. This one actually goes way out of the drift. And when it reached an absurd or abnormal level, it tended to retrace back and it kind of ended up in the mean. How about this one? This one actually almost made it to the mean and the last 2 days went down. This one finished in. And this one, look at this. It went down, then up to the max, then minimum, and then almost inside the drift, right? So this is quite interesting to see. The other thing I want to show you is this chart, which looks a little cloudy. Let's go back to our current drift. So we've stacked up all 40 quarters into one chart, right? So it's kind of a mess, to be honest, but not really. The blue drifts are the last 4 drifts, right? And notice the last 4 drifts are C, B, D, and B, right? So there's 2 Bs, 1 C, and 1 D, right? And this is the current one, and it's a D. So actually the 4, 1024, 225, and this is the 225, this one is the previous D that was in play in February. This one is the current one, July. So the gold one, just have to put my mouse on it, right? So we're kind of flat right now. We're right at the beginning. It's 100%. But you see it's right in the middle of the pack with no real, abnormal behavior. So let me flick to 20 quarters here. And now this is a little bit more interesting. I can see path where, see there's holes here and here. So there's regions where the drift will follow a path. So it looks like this drift is going to take that middle path here. Very unlikely they will drop. So most likely it will finish inside that range here. Now I can narrow it down here by having the standard deviation at 219 to 252. And I can see at what day, what type of performance they end the quarter. So 94, 89, 82, losing 6 or 8%. So far it's flat. Actually, minus 3% is what it is. So it's very good to kind of visualize all of the drift that are stacked up. So I hope you understand the importance of it and how exciting this thing is. The other thing you can do is you can click on relative to SPY, and this will tilt the drift and remove the S&P performance, right? So, and you can see the change here where you have the actual drift and the spread to the end of the drift. And you have the same thing, but relative to SPY, so removing the S&P performance. The third thing that you can do on this is the seasonality. So the seasonality here, what I'm doing is I'm not taking any earning quarter or anything. I'm taking calendar quarter, right? So I'm taking basically summer, winter, autumn, and spring, right? So Q1, Q2, Q3, Q4, really. So January to April, April to July, July to October, October to December, right? And here I can see, well, obviously the sample is 1040, 1040, 1040, because it's always this 10 summers and 40 quarters, of course. The accuracy is pretty even, 68. And the average move is -2 here on Q3, 7 here, 11, and 6. So quite different. So Q3 is actually a negative quarter for Amazon. And you see how negative that quarter is and has been over time, right? So it's in, and this one was out, way out. Okay. So we're in a Q3 now, and it's usually a bad performance. So again, we have this idea of Amazon ending in the 220 to 19 range, which is kind of the range we had with the standard deviation. 201, 233. We said that it might end up here. So this is how you can put another spin on it to see where Amazon is going. Okay, this is obviously very, very powerful. So I can type NVIDIA and see the same thing here. So this is the seasonal drift on NVIDIA. It's usually up 16% on the third quarter, 14 on the first, 30 on the second, and 17 on the fourth. So it looks like it's ending the year always on an upswing. So this is the drift. So again, this is truly unique. Very few, if not actually no platform, not even Bloomberg Murders actually displayed this thing. It's really, really unique and makes us truly different from what's out there. Now, the other thing that you can do is you can insert the drift 40 quarters, for example, here, right on the chart. So here on the chart, I can see NVIDIA's drift being drawn here. So the middle line in yellow will tell you where the mean is. The maximum will be those green dots, and the minimum will be those red dots. So if we go back to our Amazon name and we look at the drift, this is what we're looking at for the drift for Amazon. If I look at Google, this is what we're looking at. So the interesting thing with Google is that we have a huge swing here on the top. So let's look at the post-landing announcement drift over 40 quarter. We have an overreaction drift beat. So just a reminder of what a positive overreaction means. See, usually the drift A goes up 9%, drift B 10. Just happened that the drift B is one of the best here. But usually an overreaction is this. It goes like this. Fund managers are excited about a stock, just publish earnings. The analysts are positive about it. And then the fund managers say, okay, we need to allocate X tens of million to this name. So they would send a big order to the desk for execution, right? Now, what they did is, after a few days, after day 2, 3, 4, 5, or 7, more analysts are producing additional research or their view on the stock. And they're reading all those reviews, and they are kind of confused. They're like, oh, maybe we overreacted and we bought too many shares. So fund managers have a tendency to actually selling, as the drift progresses, selling their shares going forward because they bought too much. They were too excited, right? So it has a tendency to drift back. Now, right here, Google is clearly shooting up and outside of its drift. There's obviously a lawsuit here that may create that big jump or that big drop, and so maybe it's a catch up of where Google should have been. But yeah, so this is an abnormal point. If anything, and if history is any guide, and we have 20 quarters to prove it, that Google will head down back to the drift. So head down back to the drift of 235. So it finishes the drift there. Historically, it has finished the drift all the time in there. We have about 80% accuracy, 78%, which is insane. So yeah, it's pretty cool. But here on Google, I would be a little bit more toward a correction, reversion back to the mean, finishing in the upper end of the drift here. So this is how you could use the drift. Obviously, we can take it up a notch, and we'll go to the screener. So I'm going to start with a brand new screener for you here. And let's have a look at this category here called Drift PEAD. So So let me just remove a few fields here so we can start with a clean slate. Okay, so first off, you can have the drift name. So positive any reaction, positive overreaction. If some stocks don't have any drift, it means that either there's no history, so they're just been issued, or not enough quarters, or they're liquid, they haven't traded, or they don't trade much. We can increase the market cap to say $1 billion or $1.5 billion or $2 billion to filter some of these names out. The second thing, going back to the drift here, is what I'm interested in is the sample. I want the current drift to have enough samples to be significant. So when you have 0 sample or 2 or 3 or 4, it's not enough. You have to have at least 5. So let's set a limit of 5. And now I have all of those drifts that will be significant. So I have 1,600 names with a 2 billion market cap almost that have at least a sample of 5 here. Now, the second thing is I want the distance to the max, the mean, and the average. So I can click here, distance to average. And what I can do is I can do average 7 day, 20 days, 70 days, and end. So notice on the drift, there's the 7-day point, the 20-day point, and the 70-day point, and the 90-day point. So why is that important? Well, it's actually the 1-day point as well. So the 7-day point is basically 7 days after earnings. And what I mentioned last time, a few minutes ago, is the following. When analysts publish their numbers overnight, it's the first glance view on the stock's earnings. It will take them a day or 2 or 3 to run their full DCF and come up with the new estimates and revise their estimates over time. Okay, so it'll take a few days. So if we take, Apple, for example, and we look at Apple chart and look at the revision score, which tracks the analyst revisions. Look at what's happening. Earnings happen here, and then it takes 1, 2, 3, 4, 5 days, and by the 6, 7 day, everything is settled. All the analysts have modified their estimates accordingly, bumped their estimates in this case, and therefore the stock price shoots up, right? So it takes about 7 days to really 5 to 7 days to have full analysis here. So that's that 7-day point here from the distance to the average. So the average 7-day point here tells you where is the blue curve from this point in terms of percentage term. Obviously here we're past that 7-day, we're at day 43. So what I want is the end of the drift. So I want the performance from here to the end of the drift, right? What is it exactly? And what's that performance? So I can see here plus and minuses. So I can see minus 10%. So what does that mean? Minus 10%, that means that Alcoa is already up there in the upper part of the drift. And it will take a minus 10.78% for it to drop to 29. Okay. So yeah, this is really, really useful because it tells you, well, I have some downside here. The upside to the mean is inexistent, right? And I have an upside to the max a little bit. I can also have a look at the upside to the max. So the upside to the max, don't forget to put the end here. The upside to the max is 6%. So really at the maximum, I'm getting a 6% upside to the max, but a minus 10 to the mean, right? So that's taken with a grain of salt, I would say. So what you do is you sort all this and you sort for positive percentage, right? So what you're getting is a series of stocks that have 30% upside. So obviously 30% upside, that means the stock is really down outside their drift in a significant way, minus 35%, and it should rally back up. Of course, not all those stocks will rally back up, right? Because sometimes there's a real reason why they actually don't. It's because something bad happened to the stock, or bad earnings, or things like that. But for example, this one, Carpenter Technology, this one is interesting. It's usually up 9%. Well, not this quarter. It's down a lot, right? So what can you say here? Well, what I can say is if I look at the chart, it's down for sure, but the estimates revision is up. So something is off here. You can have an estimates revisions, earnings per share estimates revisions up and up, and the stock retracing back or going down, right? That's usually like a weird sign. So if anything, it looks like the stock price here is done going down and might retrace back inside the drift. And if that's the case, it will go into 310 and 246, right? Drawing the standard deviation, 264 might not be an abnormal drop there, an abnormal target, and it could go there. TGG has had a big drops this quarter. Of course, it's a fairly volatile stock. We've seen it, and they also paid a big dividend. But this is what we're looking at the bottom of the drift. Of course, the range is wide, but you can focus on a standard deviation here and see where it's going. So how do we use this? We use this as an opportunity to see if there's upside or not, depending on your view. So either you take the mean, the average, or you take the maximum view and see if there's more upside or not. Okay, so if I, for example, focus on the negative, right? For example, I don't want the stocks that have passed that green line, right? Because I basically have no upside. So what I'm going to do is I'm going to, because for example, if I click this one, I still have 2% upside. So what I'm going to do, I'm going to zero in on that distance to max. That way I have, the opposite. That's not what I want to do. Oh yeah, actually, this is, no, the opposite. Zero in here and remove that filter here. Okay. So here I only have stocks that have that are above their mean but below their max, right? So that's interesting, right? If I really think the max is achievable or attainable, I can play it that way. Still have 25% rally to the end of the maximum, and I'm way above the mean here. So obviously this is dangerous, right? Because you're betting that the stock will shoot up more all the way to the max. But it has, as far as the mean is concerned, these guys obviously no upside, right? They're above the mean. Conversely, you can take the view that if I take the opposite view here, where I have, for example, this guy has 44% potential rally to the mean, or this guy 42%, it's really at the bottom here, or let's take more chewy 20% possible rally to the mean. This stays in the realm of possibility. Okay, you can also have a look at last earning date. So click on date, and you see last filing date, and then you have the date of filing, and then you can sort